Financial history tells us that stocks outperform all other asset classes in the long run. In most developed countries of the world, stocks have outperformed other assets like bonds, treasuries and gold by a very wide margin. In India also, during the last 40 years, stocks have outperformed most other asset classes, comparable asset classes, by a wide margin. It is important to know why stocks outperform other asset classes. Stocks outperform other assets because of the nature of economic growth. Without going into the complexities of macroeconomics, let me explain this with the help of a few examples. Two popular investment choices of Indians are bank deposits and gold. Then there are other assets like small savings, public provident fund, etc. When a person deposits money in a bank, he is lending money to the bank. The bank gives an interest, let us say 7%, and the bank lends it at 11%. The difference between the two, 4%, is what we call the bank's net interest margin. If the bank does well, the bank makes a lot of profit, but as a depositor, you will not get any profits which the bank makes. You get only the interest. When you buy gold, you are investing in an asset which is not productive. It is actually idle savings. But in India, gold has been a well-performing asset class, though not comparable to equity. Particularly, it has been a hedge against inflation. That way it is good. But investment in gold is not a productive investment. If you buy jewelry particularly and put that jewelry in a safe deposit locker of a bank, it lies there. It is an unproductive asset. And that is why it does not create any value. If you are investing money in small savings by like national savings certificates, well, the money is utilized by the government for financing its deficits. All governments have deficits, and deficit financing is not a very productive form of investment. But if you buy stock of a company or subscribe to the IPO, initial public offering of a company, you are becoming the owner of a company. You are becoming a part owner. When you buy, let us say 10 shares of Larsen & Toubro or TCS or Maruti, you become the owner of that company. So you are buying ownership in the company. And in a growing economy like India, these companies do well. Good companies do exceedingly well. And when they do well, when their top line and bottom line go up, you also benefit out of that. Apart from that, there are the tax advantages also. Dividend income from direct equity investment is exempt from tax up to 10 lakhs. Long-term capital gains up to 1 lakh are exempted from taxation. Long-term capital gains are capital gains arising out of keeping an investment for 1 year and selling it after that. So this is applicable to direct investment in stocks and also to equity funds and hybrid funds. Of course, in equity funds, the dividends are taxed. So because of this tax advantages also, in the long run, investments in stocks do exceedingly well. In India, during the last 40 years, the stocks have outperformed all other asset classes. Sensex was 100 in 1979, now it is beyond 38,000. That means it has multiplied 380 times, giving a CAGR of more than 16%, excluding the dividend. But it is important to understand that this growth will not come in a linear fashion. Returns from the stock market are not linear, they are cyclical. During certain years, the returns will be very good. In certain years, it can be moderate. In certain years, there need not be any growth at all. And there will be a few years in which the returns can be even negative. During the last 20 years, there were small negative returns. During 4 years, not 4 years, 6 years, returns were negative. But in 14 years, the returns were positive. And some years, the returns were positive by a huge margin. So in the long run, there will be wealth creation in spite of short-term disappointments. Therefore, the best way to participate in the emerging growth story of India is to invest systematically in stocks and equity mutual funds. Those who have the expertise to do that can participate in this by directly investing in stocks. Those who do not have the expertise can invest in equity mutual funds, hybrid funds, and those who have deeper pockets can choose the portfolio management services. Invest and grow rich.